Today I'm going to show you how to pass your prop challenges and instant funds challenges where target's applicable faster while scaling in accordance with good risk management. In the example I'm going to show you, this will allow you to pass a challenge with a 20% profit target, 50% faster by scaling, which is huge. You know, it's the difference between passing a challenge in say 12 months and actually doing it in 8 months. It's a pretty big deal. Make sure you scale with appropriate risk. We're not taking risks here. We're keeping our risk solid throughout, but we're scaling at appropriate moments, and there's a reason we can do that. It's very reliant on the right kind of drawdown in certain conditions, and I'll explain them throughout the video. But before I continue, I would just like to say it means a lot to us if you subscribe, and many of you haven't. You just maybe watch our videos as they pop up on the home screen and you miss to subscribe, I guess. So if you like the content we create, then please quickly double check if you have subscribed, and if you haven't, please do so. If you'd like to, it costs you nothing, and this one-click action really does mean a lot to us. So for this scaling principle, it can be applied to any challenge. No, that's not true. There is a condition of the type of drawdown, but it can be applied to any challenge with this type of drawdown. And for demonstration purposes, I'm actually going to compare the expected time to pass a challenge with an FXIFY instant funding account and their conditions, and an Xrading account and their conditions, and how actually for the Xrading there's a 20% target, but we can actually hit that faster than the 10% target in the FXIFY account by applying this principle. So let's take a look at what I mean. So on the screen here, first of all, I've got the Xrading website up. And so we'll look at comparing a $10,000 account. This for Xrading is an initial deposit of $1,000. And we can see here that what we need to do to progress each stage. So for this one, it's great. We've got all these stages where we scale up our capital a lot and we take our profit share accordingly. And to go through that, there really are no complex rules, as it says. There basically is just a don't go below the 10% starting equity, and that is static. Okay, and this is what's very important, this drawdown being static. So we don't have daily, which is another thing that can be an added complication, but the main thing I want to compare here is the trailing drawdown versus the static drawdown. What that means is essentially we'll start with a $10,000 account, and so therefore if we go straight into drawdown of 10%, we can go down to $9,000. But even if we grow the balance 10%, we're still able to go back down to that $9,000. So our drawdown actually becomes 20% if we're 10% up, which is a big benefit and allows us to scale, as I'll show. And we're aiming for a 20% profit target. No time limits. Simple as trade anything you want, and that's the rules for Xrading. And by comparison, 20% seems like a pretty reasonable target, but let's do some maths. So by comparison, here's a one-phase account on FXIFY. It's a 10k account. We've got the profit target, and this time we've only got to hit 10%. But there's two big differences. One, we do have a daily loss limit of 3%. As I said, the main thing I want to compare is in this case we've got a max trailing drawdown. Now it's also lower, 6%. So we're comparing two things. We're comparing the lower drawdown, but really the thing I want to focus on is the fact that it is trailing. At a glance, we might think, yeah, the 10% is going to be faster to hit than the 20%. So let's take a look now and do some maths. I've got a spreadsheet here. It's simple. I put it together reasonably recently, and I'll walk through in detail and explain. And what I'm doing is I'm looking here, let's just focus on this part here. I'm looking here, first of all, we've got the 6% trailing drawdown with a 10% target. Then we've got the Xrading 10% fixed drawdown with a 20% target. And finally, I've got the effect of the scaling here, right? And each of these is also down here. So let me explain. At first glance, it's like, what's going on here, Sam? Okay, so each of these all has a 10,000 capital. For comparison's sake, assume that we're dealing with a strategy that makes 1% a month with the, let's say, the 6% trailing drawdown. If we set the risk appropriately, we're going 1% a month with a 6% trailing drawdown. Now, this is reasonably realistic. We've got lots of on our website here. If you go to results, funded trading, here's an Xrading account. We've got 233 days of history, nearly 1,000 trades, and it's showing to be making about nearly 2%. And we can even click here and go in the track record. I'm sure the FX stabilizer is a pretty steady growth curve, and so it's probably going to be pretty linear. So yeah, Xrading, we've made the FX stabilizer has steadily grown by its monthly percentage until it hits the target, and then the account is scaled, and we move on to the next phase. So it's actually a good example of how the Xrading account kind of scaling scaling could really help grow your capital. And so if we go back to the spreadsheet, we can see here, very simple maths. We're just going 10,000, and this is month 1, month 2, month 3, month 4. 1%, we've made $100. And all I'm showing down here is this just summing up, right? So it's just the cumulative. So it's $100 and $200. And if we keep making that a month, all the way up to month 10, where we hit our 10% target. The same thing here, but this time we've got to understand that because we've now got a 10% drawdown, if we trade the same lot size on an account with 6% and 10% drawdown, that's not a fair comparison. So we're able to, you can see I've put a factor in there, we're actually able to multiply our risk by 1.66 because we've got a bigger drawdown. So in actual fact, in this case, we're going to make 167 a month. And so to get to 20% in this case, as we can see, if we just keep adding the 167, it takes us 12 months. So it's actually not that much longer, even just with this simple comparison, it's not that much longer to get to 20% just because of that extra 10% drawdown versus 6% drawdown. So it's very important what that value is. Not to mention it's less risky because we don't actually have the added complication of a daily drawdown in case there is a fast daily move. And that's a bit harder to backtest. The value of that is shown to be very important there because it certainly doesn't take twice as long. Now let's look at the scaling and why we can only do that with a fixed drawdown. Because this trailing drawdown, it's always going to be 6%. If we make $600, we're up 6%, and the drawdown's now moved up so that if we drop back down to the original starting balance, we're going to lose the account. Now, once we've set our risk, the strategy can potentially always have its worst drawdown, and so you can't do anything with that. You just got to leave it. It's a fixed lot size wherever it is, and you just got to let it trade. But with a fixed drawdown at its original point, if we've made 10% on this account, and this is where we'll look at scaling, if we've made 10% on this account, well, we can go all the way back to the original fixed drawdown starting point, which is actually $9,000. So instead of the original starting 10% fixed drawdown, if we make 10%, we can now drop 20% from that point all the way down to the $9,000. It's just staying there. And that's a huge advantage because what it means is for the first few months, we're going to make this amount of money and we're going to hit a point where we've made $500, right? And so from that point, we're actually up, we're 15%, our equity is 15% away from the drawdown. So really we can increase our lot size now by a factor of 1.5 because it's 15% over 10%, right? So now from this point onwards, we're actually making $250 a month, okay? And then a couple of months of that, and we're hitting $1,000. And so now we're actually up 20% away from the drawdown, the static drawdown, because it's just staying there. And so at that point, to stay within the risk, now our risk's too small again. We can actually now double our original lot size. We can now make double this 167 a month, right? Because we can go all the way down to 20% drawdown. And so now we're making $333 a month. And then it doesn't take too many months of that to finally hit our $2,000. So now we've hit our 20% target. So by scaling twice, essentially, and you can do it more, but by scaling twice, this is appropriate for demonstration purposes. By once we've made 5%, we can increase a bit and make more profit a month. And then once we've made 10%, we can double our original lot size. We've now actually hit 20% in 8 months, and we've not taken any extra risks. So the scaling is very, very powerful because now, as we can see, instead of just letting it take 12 months, we've now taken 8. So it's 50% faster, and it's also even faster than the 10% target here because of the drawdown. So I hope that demonstrates it. First of all, it's very important the size of the allowable drawdown. As I've shown, that alone can have a big effect. As I showed that we didn't need twice as long to get to 20% just because the drawdown allowance was bigger for the Xrading. But because of that fixed drawdown, we're also able to use the scaling advantage, and that can really speed things up. There are some numbers there. It's a bit hard to explain, but I really hope I've broken that down, and you can see clearly that we're not taking bigger risks to pass faster. We are just keeping the risk at the same point, but we're just taking advantage of this static fixed drawdown to scale up as we go through the challenge. Now, of course, you can apply this to any challenge as long as that all-important fixed drawdown is there. When looking for prop challenges and instant funding, it's certainly something I focus on so that I can start to scale things up and know that I'm going to speed up hitting that profit target. You could even do it more aggressively than I've shown and say scale up every time your account hits 2.5%. Just scale up a little bit, not maybe maybe 1.5, maybe it's 1.25 several times, and do it maybe in 6 months. I don't know. I haven't done the maths. Just make sure that risk always remains the same throughout the challenge. You should, at any point when you're applying it, your back test should never have shown that if you trade that risk size, that you'll exceed that drawdown that you have available to you. Those results were very realistic. If you go back onto the website, there's many results. We've got the funded trading, the prop challenges, our live trading, and you can see that there's loads of different strategies here. The Xrading actually doesn't limit. You can trade any strategy. You can trade third-party strategies. There's no limitations. Just stick within that 10% rule. So there's lots of great strategies here where we show our track records. You can see here nearly 2% a month. And if you join up for the VIB club, you're able to get all the set files that we're trading too. And so there's just loads of information to get you very quickly up and running. Kind of just pick an EA that looks good to you. It's making that rate, and you can do the math, same as I've just done in the spreadsheet, to figure out how long it's going to take to pass, apply that scaling if you pick the right challenge, and you can repeat this process. There's a wealth of information there to get you up and running very quickly. So there we go. The advantage of a fixed drawdown challenge to greatly speed up our time to hitting the profit target. And in this case, it actually lets us pass the instant funding Xrading challenge with a 20% target safely in 8 months, maintaining the low risk that we've set right from the start. So I hope you found that helpful. Also, check out this video providing a free expert advisor for trading gold. Bye for now.